26-year-old Sadie in Seattle's CPA made her feel like an idiot for converting her 403B to Roth and told her that every dollar she puts in a Roth IRA will be taxed again. Is the CPA right? That and more tax and investing spitballing for 20-somethings is up next on this bonus episode of Your Money, Your Wealth, or YMYW Extra. I'm producer Andi Last, and you, the YMYW listeners, have sent us so many excellent and detailed retirement spitball requests that Your Money, Your Wealth hosts Joe Anderson, CFP, and Big Al Clopine, CPA, can't even handle them all. So I've enlisted the help of financial advisor Tony Vu, CFP, from Pure Financial Advisors office in Brea, California, to help out. Now, it's important to note that this is just a spitball for educational purposes only. Even if you've given us a lot of details, we don't know everything about your financial situation, so don't take this to the bank. Here's Tony's spitball. Tony, thank you very much for helping me to get to some answers for our very patient YMYW listeners. I really appreciate it.
Glad to be here, Andy.
All right, so we have this question from Sadie in Seattle. So I'm just going to go ahead and read the question to you, and we can go through it. And this has been sitting around since April, so we really need to get to these questions.
All right, time sensitive.
Yeah, exactly. She says, please consider my question on the show as it's a little different. I know that the more advanced generations have all the money, but it would be super awesome to hear your spitball about some younger listeners who are still trying to figure it all out. Maybe my question will mix it up a bit. I'm not asking about a Roth IRA, maybe just a general yes or no if I made a bad decision. We are 26 and 29, drive a 2005 Toyota Prius and a 2017 RAV4. We've never had a car payment. I think we've spent more money on mountain bikes and skis than we have on our two cars, and that's just fine for now. So these are very active people.
Yeah, living the life right there.
Yeah, absolutely. She says drink of choice is an old fashioned, which is a YMYW favorite. Pretty much everybody on that writes into this show drinks old fashions for some reason, or an IPA drinker, and that's another popular one. And she says, guys, you're not too old to enjoy an IPA. Just order one that is not a hazy. Now, Big Al actually likes the hazy IPAs, but Joe can't stand IPAs of any kind. So, Tony, what's your drink of choice?
So I'm going to go with Sadie here. I'm an old-fashioned person as well.
Wow, okay.
Kind of in the neighborhood. Here's the secret. I like to make my own. And so to kind of smooth it out, the secret is using some orange bitters.
Oh, okay.
Yeah. So about, let's say 2 dashes of bitters, 1 dash of orange bitters, kind of smooths it out. It's perfect. Regards to IPA, I'm not too much older than you, Sadie, but I'd say I enjoy a good session IPA. Just kind of smooth it out too as well.
There we go.
Free tips right there.
Yeah, right. Exactly. To go along with the financial suggestions and the spitballing.
Oh yeah.
She says we're both from small towns in northern Idaho, so of course we still drink Coors, and I, without shame, still love a Pabst Blue Ribbon when I'm back in Idaho. I love a $1 pitcher of semi-cold PBR. Blah. Okay, Sadie.
Hard to say no to that.
She says we make around $260,000 per year. He is a mechanical engineer and I am a registered nurse. I quit my full-time job and just pick up shifts in the ER when I feel like it. So our income varies. Usually I will make around $100,000. So her husband's making about $160,000.
Mm-hmm.
So for retirement, husband's 401k, the company matches 9% for the 8% that he contributes. So he's got 130-ish total. That's $60K in Roth, $60K company match and contribution, and $9,000 pre-tax contribution.
Okay.
Her retirement is about $73,000 all in Roth IRA. And she just started a new job contributing both to pre-tax and Roth 403Bs. She's got about $12K now. Some money also in employee stock plans. And she says, we max out company match, backdoor Roth IRA, HSA, and FSA. She says we have about $40,000 in cash in savings accounts, about 5% annual percentage yield. That's for a savings account. That sounds amazing.
Yeah.
Thinking you can only do that with CDs.
Not in this day and age. It sounds like probably an online bank of some sort. So, I mean, with interest rates where they're at,
right,
it kind of works both ways. So, I mean, good for you, Sadie, in terms of putting that extra money there.
Absolutely. She says we bought our home in 2019 for $350,000, 15-year, 1.8% mortgage rate, and owe $220,000. We now regret the 15-year we chose. Our home is worth about $600K. We've been renovating it ourselves, knocking down walls, plumbing, electrical, etc. We've been paying in cash as we go along. We spend money on hobbies, biking, skiing, and take about a month off a year to travel. Nice life. I like it, Sadie.
Gosh, I'm envious here.
Yeah, right.
Yeah, yeah. This sounds like my life before kids.
There you go. She says we cannot write off anything beyond the standard deduction as we do not have student loans, no, much mortgage interest, etc. So here are her questions. So number one, should we consider putting our retirement contributions in a pre-tax 401k instead of Roth to bring down our taxable income? Is there any other ways that we should bring down our taxable income? Maybe we should have bought a Tesla last year. So let's talk about that.
Yeah, so the way I'm looking at it right here, Sadie, I mean, you're thinking about it the right way, but I look at it like this. You're 26, husband's 29, you're on the fairly young side of things, right? And with the income that you're both making right now, I would imagine that it's only going to increase over time, right? So you're going to take a bunch of trips, but you're going to probably start making more with more experience, more seasonality. So you're going to start making more, and there's going to be plenty of time for you to put money in a pre-tax basis. But the way I'm looking at it is that right now is probably going to be when, I mean, ideally is when you both would make the least amount of taxable income in your lifetime before retirement. And with the rate and where things are going, I would argue that over the course of the next 3 decades, taxes are going to go up. Okay. And if taxes go up and you make more, you're going to be, no, that's probably a better time to do more of that pre-tax stuff. But right now, I would say it makes more sense for you to focus on the Roth.
And she says, I keep reading more or less Roth depending on the tax bracket when you retire. And she said, I have no idea what tax bracket or what our income will look like in the next 30 plus years. But historically, that's generally the way it works is that as you get older, as you get into your 40s and your 50s, that's when you actually reach your highest income earning years, right?
Exactly. Yeah. You historically, you should be reaching your peak earning years then. How
And
you
let's say she listens to YMYW, so she's already very actively involved in her finances.
Oh yeah. Oh yeah. So it's just like how you set yourself up now will determine what your taxes are also going to look like in 30 years. So it's a combination of what the environment's going to be, but also how you save. So I would argue that, take the ambiguity out of the window. You're probably given your income, and if you guys are using standard deduction, so 260, I'm just going to assume that most of your contributions are Roth. So we deduct the standard deduction. That's about, call it 29,000 bucks. So you guys might be, and then also that, HSA. It sounds like you're doing HSA and FSA. To me, it sounds like maybe one's doing the HSA, the one's doing FSA, because normally you can't combine those together
Got
unless
it.
you're each doing it. I mean, I imagine your taxable income is probably around $220,000 a year. That's putting you right there in the 24% bracket. Okay, that bracket is scheduled to change in a couple years. 2026, it's going to go to 28. So that alone, you're going to find yourself in a higher bracket. Maybe you can shift gears and start going pre-tax then. But for now, 24% is going to be very cheap in relation to where it could go in the future. So I would argue that you're better off sticking the course and going Roth right now.
And as Joe Anderson always says, is if you take the tax deduction now, it's not like you're going to miss it, later if you do the Roth now instead.
Yeah, all that money is going to be yours.
Yeah,
Yep.
right. Okay, her second question. She says, I moved my old pre-tax 401k and converted it to a Roth IRA. Was this stupid? I met with a CPA and he told me this is not something people in their 20s should be doing. I was fine paying the tax bill and felt good knowing that I moved it from a terrible 403b to an account that will be tax-free one day. He made me feel like an idiot. He also told me that every dollar I put into the Roth IRA will be taxed again, regardless if it is from after tax or non-deductible IRA contributions. Am I completely wrong?
No, you're not. I mean, sounds like a terrible CPA off the bat to make you feel that way. I'll say this much is in my kind of 14 years of doing this, not a lot of people in their 20s are thinking about these type of strategies. So first and foremost, kudos to you for listening to the show and thinking about these type of things. But going back to what I mentioned earlier, you're probably in the lowest tax bracket you're going to be in now. So when you did those conversions, the 24% bracket, like I mentioned earlier, it's very wide right now.
Right.
Odds are when you did that conversion, you probably still were just in the 24%. You pay the tax at 24%. But the idea with Roth is that you pay the taxes on those dollars now. And then when you take it out, as long as it's a qualified withdrawal, then you don't pay any taxes on the earnings in the future. And I think where you could be a little confused or things could probably cross a little bit is that, I mean, all the earnings that you have in that Roth, once you did that conversion, all the earnings that have built up, If you take it out before 59 and a half, then yeah, you pay taxes on the earnings. But whatever you converted, that $70,000 or whatever the case was, you can always take that principal back out. After 5 years, you can take it out tax free. It's because you already pay taxes on it.
Yep.
Yeah. So he's wrong in a couple of, standpoints in terms of, paying taxes on those dollars. There's certain conditions tied to it, but it doesn't seem like conditions that you're probably going to be running into.
You know what? It just occurred to me that she made a comment in the first question about maybe we should have bought a Tesla last year. Can you explain why she mentioned that?
Yeah, I think so. Part of the idea is that I think, as what you mentioned earlier too, Sadie, is that you're looking at ways to reduce your taxable income. So in essence, there's only two ways to do that. You either lower your taxable income by doing pre-tax deductions. So these are things like putting money in a pre-tax 401k or in a pre-tax retirement account, HSA, FSA. These are things that you set aside that reduces the first line on your tax return. Okay. So that's one way that you can reduce your taxable income. And by reducing your taxable income, you pay less taxes because there's less income to tax you on.
Mhm.
But another thing that's available to folks is tax credits. And so I think, Sadie, what you're probably referring to is the Inflation Reduction Act and the fact that right now there's a tax incentive where if you're buying certain vehicles, maybe certain Teslas, you get up to a $7,500 tax credit.
It's specifically for electric vehicles and hybrids and things like that, right? Not
Yeah,
necessarily,
yeah, there's a whole
not
criteria.
just Teslas, but
Yeah. So I'm not going to sponsor Elon Musk here, but I'm
right,
just saying a couple of his cars do qualify.
right.
But yeah, there's certain criterias in terms of the vehicle itself, where it's manufactured, and certain provisions. But there's also income limits too. If you want to get the tax credit, you have to have certain income limits that you have to fall in to get the full credit. If not, it gets phased out. But the idea is that, hey, if you have a tax bill, when you get a tax credit, it's a dollar for dollar reduction. So the way I kind of look at it is that, if you owe $7,000, if you owe, let's say, $8,000 to the IRS and you have a $7,500 tax credit, you only owe them $500 at the end of the day. So credits are very attractive. But I would caution you, don't let I would say don't let the tail wag the dog. So don't let the tax tail wag the dog. If you want to get it, if you need to get a new car, you have to get a new car, and you happen to want to get a Tesla or anything that qualifies for a tax credit, sure, that's a nice incentive to go along with it. But don't get the car just to get the credit, because you're still spending dollars to save cents at the
Yeah.
end of the day.
Focus on the long-term goals, maybe.
Yeah, yeah.
Yeah.
So if it works, it works. But yeah, the tax credit would help in that sense.
All right, so let's go on to the next question. She says, when do we know it's the right time to work with a financial advisor? I've heard that when you have over $500,000 net worth, we feel comfortable managing, but maybe there are ideas to help us offset the taxes we pay. So, Tony, when is the right time to work with a financial advisor? Not that you have any bias or anything, right?
So no bias with this here. I'm just saying this the way I think it is, that whenever you feel that it's more than you can handle, you should be consulting an advisor. I think what you're probably referring to with the $500,000 net worth is that a lot of advisors in our industry require a certain minimum for you to work with them before they give you any level of advice. And usually that $500,000 comes in the form of like, hey, you need to have $500,000 for us to manage your investments, and we'll provide you financial planning advice to go along with that. Now, a lot of firms like ours have kind of went away from that notion. We understand that folks are looking for guidance. We do manage investments for folks, but we kind of start every relationship out first by doing the planning first. Okay. We charge a flat fee for that. Other firms might do a little bit differently, but we work with clients with $0. We work with clients with millions of dollars. And whenever you feel that it's a little bit more than what you can handle, or you feel that the cost of a mistake might be more than the cost of hiring just an advisor for a consultation, then that's the time to work with an advisor.
Well, and there's more to it than just managing your investments, right? I mean, as she mentioned, there's also looking at the tax strategies, but then also like if you're about to have a kid, then you want to start looking at, other long-term planning or insurances or things like that. Or, later on, you might be considering estate planning and need somebody who can actually advise you on all of that, right?
Yeah, exactly. Financial planning, the way we look at it, and financial advice encompasses anything that affects you, financially. Probably using that word a lot. But I think there's no right or wrong time to do it. But the way I look at it is that if you feel that you're not comfortable doing what you're doing now, and I think in our day and age with the information out, the information is great, but there's a lot of information. But if you want information specific to your situation, and then yeah, you should seek professional guidance or advice from a financial advisor.
All right. And then she has a final question. We have quite a bit of money left over every month. Should we consider investing outside of retirement plans or IRAs? If so, any suggestions where to start? Thank you for considering my questions. Would love to hear your spitball if we are on the right track and to any of the questions. Thanks again, Sadie. So where should they be investing after they do their retirement accounts?
Yeah, so this is going to be where it really depends on your goals. So I don't know, like with your situation, if you guys are planning on like changing houses, if you have any other like short-term financial goals, anything you want to purchase, any big expenses in the horizon, because that would dictate if you should be saving more in the retirement accounts, because it sounds like there's some room to kind of max those out. You're just putting up to the match, which is great, but there's still some more room to add extra dollars in. And just remember that like with these type of accounts, like especially like a Roth 403b or 401k, you can only put money into those accounts while you're still working there. And so with leftover money, just depends on your goals. If you have something that's coming up, then you should continue doing probably what you're doing right now. Usually we recommend about 3 to 6 months worth of expenses, like in some type of like high savings.
Yeah.
Anything above and beyond that, you can get it invested in a brokerage account, but that's if you don't have it for any particular goal. I would argue that if you have no particular short-term, mid-term expenses or big-time expenses, then you have some room to kind of put more money in your retirement accounts.
All right. Do you have any other suggestions for Sadie and her husband on things that they should be considering as they move forward?
The only thing I would say is just if you're working with that CPA, look for a new CPA. But that's it. You guys are doing a great job. You're in your 20s and you're already thinking about things like this that will affect you 30 years down the line. But you're kind of starting with the end in mind right now, and just making sure that I think for younger folks, time is a good and bad thing. You got a lot of time that will amplify your decisions. So you make the right decisions now, it's going to get you in the best path in the shortest amount of time. If you make bad decisions, then that could cut some time off, and then it would cause you to make up the time. So
fantastic. That is Tony Vu from Pure Financial Advisors. Tony, again, thank you so much for the help. I really appreciate it.
Thanks for having me, Andi.
And Sadie, thank you so much for your question and for your patience. YMYW listeners, see the video of this spitball on our YouTube channel. I'm in the comments daily responding to you and taking notes to tell Joe and Big Al what you think, because Your Money, Your Wealth is your podcast, and this show would not be a show without you. Click the links in the show notes to get free access to helpful guides and white papers, a blog, educational videos, and much more to help you get retirement ready. You can subscribe to the YMYW newsletter as well, so you never miss Joe and Big Al on the Your Money, Your Wealth TV show and podcast. And when you're ready to get serious about crafting your retirement plan, schedule a free financial assessment with one of the experienced professionals like Tony Vu at Pure Financial. Because really, to make the most of your money and your wealth, you need more than a spitball. Help us grow Your Money, Your Wealth by sharing the show and by leaving your honest ratings and reviews in Apple Podcasts and any other podcast app that accepts them. Your Money, Your Wealth and YMYW Extra are presented by Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.